the man that needs no introduction, chief market strategist at the Carson Group, none other than Ryan Dietrich. Good morning to you, Ryan.
Good morning, guys. Excited to be back. Every time I hear that song, it just, it gets you pumped up for a Friday. So thank you so much for having me back. How's everybody doing?
Oh,
We're
I
good.
like the Stat Cave. I like that. That's new coming
Yeah.
from feed. Yeah, welcome to the Stat
Yeah.
Cave.
Can you see it okay? I guess let's see here. Go that way a little bit. Is it blurry? Maybe I got the blur on behind me. But either way, I just dropped my dogs off at to get groomed. I haven't seen how'd the jobs number do. What are we doing? Then I can get into my stuff.
Doesn't
What's going on?
matter. We go up no matter what, Ryan. Like,
The
what
bull
does it
market.
really matter here?
Yeah. No, probably
Bulls
not.
have grabbed control. They have chased the Bears into their caves, and I don't see how even is the Stat Cave going to make us bearish here? Do you have anything here? No. He says no.
No, not really.
Okay. So all you Bears out there, I'm sorry to disappoint, but I don't think Ryan's going to come on here with all the bearish stats when stock market's making new all-time highs.
Yeah, you're probably right. I am sharing my screen. I know once you guys pull it up, let me know, and we'll just get rolling.
Let's get rolling. Let's roll it.
Awesome. All right. So, I've come on with you guys once a month for a long time now. So thank you for that. I shared
maybe
this
a decade.
Chart. Yeah. I've been sharing this chart this year. Well, really since June, right? We hit an all-time high on June 2nd, S&P 500. And we noted at the time that, listen, there's never been the ultimate peak in June. And now, maybe we can slice and dice why, but you can see it's the only month. Well, told you. We said this would not be the first time ever where the only all-time high was in the month of June. And I've got 20 slides. So, I get rolling. I start talking fast, start having fun. We've been bullish. Yes, I've come with you guys for a while saying it's perfect. What's going on? The pass the baton. I mean, we gained 16% on the S&P 500 in April and May. We had literally the largest second quarter return ever, I think like 15% this year for a midterm year. And then we all know what happened, kind of consolidated, caught our breath. Everybody's getting all angry because I was still pretty bullish. A few bulls that were out there. I mean, lots of well-known bulls are talking about 15, 20% pullback second half of this year. Carson Group, we released our mid-year outlook. I'm on record at the middle of the year saying that 9.1% peak to trough is probably the most we're going to see this year. Doesn't mean we're not going to have volatility and some bad days, but there's a lot of reasons to think that this bull market's alive and well. And now here we are on the other side of it, making some new highs after we had the AI momentum, just destruction, obviously, of last month. And we know what happened with software, all that stuff. But now here we are on the other side of it. And like you said, I just looked, and yes, futures are up a little bit. Who knows? But I hit all-time highs today. So, which I think is a good thing. So quickly on Carson Group, we're an RIA. We have over $60 billion. I'm in the research team. We've got a 15-person research team. We manage more than $8 billion. So yes, I take a little bit longer term look at things and kind of have maybe a glass half full mentality, but I'm a steward of assets, right? We have a fiduciary obligation to look at the data, manage real money and how we see it. And we've done pretty well overall with how we've seen it. And what I'm sharing here in these next slides are literally a presentation we give to our advisors, right? Every Monday we give it a presentation. I've got some new stuff, but really these are some things we've shared with our advisors and how we see the world. Now, this is a concept I brought up a lot. I think it's kind of important. The bull market's not as old as everybody thinks. Now that we're back at new highs, the bull market's kind of back. It started October 2022, October 12th, 2022. So 3.8 years old. You can see here, if you squint real closely, the other 5 bull markets that made it to at least this point, check it out. 2 have made it to 5 years. 2 have made it to double digits. Who knows how long this one will go? But we've talked about this concept for a long time. Once this bull market got to about over 2 years old, sometimes you have them flame out in 18 months, 20 months, whatever. Once you get to 2 years old, though, it's kind of that magic number where bull markets are like a cruise ship. Once they get moving, they tend to keep moving a lot further than you think. And then really breaking it down, back to World War II. This is the 8th longest bull market ever now. And as you can see here, the only one that didn't make it to at least 5 was one like back in the 60s. Okay. So again, the average out of the other 7 that lasted longer than this one, once they get to this point, was over 7 years long. Now, listen, we have no idea, right? I mean, listen, we manage tactical models. We manage longer-term strategic models. I mean, I've been in the camp, and I still feel this way, that this bull market could have several years left. I know that sometimes makes a lot of people angry when I say that, but we've been saying it for a while, and we're still in that camp. Of course, it can always change, yes, but just have these concepts in the back of your head, I guess, as we're moving forward. Because listen, I mean, a month and a half ago, you could give some pretty good bearish arguments. You could give some good bullish arguments, I would have argued. But I think just knowing the bigger structure of a secular bull market that we are in, and we've been in my opinion, since April of 2023, or March of 2013, sorry, when we broke out above that 13-year secular bull, we've been in a secular or secular bear, I should say. We've been in a secular bull ever since. And it doesn't mean you have a 2022 when you lose 25%. Doesn't mean you can have a 34% 100-year pandemic. But just, again, those things happen quickly, kind of like 87 happened quickly during that long-term secular bull market. So again, long-winded way of saying I still think we're in a pretty solid bull market. Now we'll get more into some of it. It is what it is. Market breadth. Advanced decline lines were telling us new highs were coming. Literally the Tuesday before the Fed day. Remember 2 Wednesday ago, Fed day, market got annihilated because whatever, didn't like what he said or didn't like what he didn't say. I don't know, but the market dropped a lot. And I was around like that Tuesday saying, hey, new highs are coming pretty soon because of market breadth. And you could imagine when the market got lit up like it did after that. A lot of bears come out saying, okay, yeah, look at that, look at that. But we've been seeing this with the New York Stock Exchange advanced decline line hitting new highs, S&P 500, small cap, mid cap. Market breadth leads price is how I learned it a long time ago. And we're still seeing that broadening out theme with a lot of participation. And now you look, and all of a sudden, tech's doing pretty well, right? Tech just like XLK, right? I probably have to say this, not a recommendation. But we had over a 10% rally in 4 days on XLK. The S&P 500 up almost 6% in 4 days. Take a wild guess. Normally those things happen near major lows, and I get it. This one's happening, at least for the S&P 500, at all-time highs. That's really rare. The four most dangerous words, Sir John Templeton. This time is different. Well, it is a little different because we had so much strength near all-time highs, but I'd still side with it's a buying thrust, it's strength. And then those other times, tech was up 10% in 4 days. You're talking off like COVID lows and off the Liberation Day lows, like going back like a decade. I mean, that's small sample size, yes, but pretty good time to be optimistic from that point of view. Okay, here's another one. This is a big picture, cool chart from Stock Charts. Advanced decline lines peak way before the market, on average about 11 months. Okay, so it doesn't mean the market can't keep going up. A lot of us older remember this stuff or heard about it. Late 90s, advanced decline line rolled over, market kept going up, eventually it fell apart. 2007, same thing. Bank stocks obviously started to crack way before the market did in 2007, and then we all know what happened later when the market took a 56% haircut. 2008, 2009 into 2009. But just big picture, breadth is telling us the market likely will continue its upward trajectory for a while. Here's just a bigger picture chart of the KBE, right? Bank stocks. So bank stocks were telling us a warning sign in 2007. I would argue they're given another warning sign, but it's a different warning because it's saying now banks are leading, banks are breaking out and going nowhere for like almost 20 years. Honestly, if we put a chart of Europe on,
that's crazy chart.
Looks the same thing. I mean, I remember coming on with you guys literally like March, April of last year saying, listen, stuff's happening in Europe here. There's a lot of spending going on. There's some strength going on. There's some potential positive on the economic front. We're with a really smart guy named Sonu Varghese. And I am wearing a Facts versus Feelings shirt. I didn't even know I'm wearing it. Honestly, I wear these all the time. I have a podcast, little disclosure of Facts versus Feelings, but Sonu looked at all this macro stuff and he was saying there's some positive things happening in Europe. This was 16 months ago, 17 months ago. And how's that done? I mean, yeah, pretty darn well. So you see these, the longer in, longer the base, higher in space, Luis Yamada. We're seeing, tech's way up here and stuff, but there are other groups like banks and financials that you could argue are just now starting to get started in a bull market. That's the camp we're in. When we manage billions of dollars, I would say we're maybe 53% growth, 47% value. I don't feel comfortable making a really big bet there. I mean, I think there's a lot of opportunity on both. Not trying to be too cute here. So we're pretty split when it comes to that, just in case people are wondering. Now, there's always worries, right? This is something you got to feed the bears once in a while. We were lower in June. What was it? June and July, right? And July, I think I probably joined you guys last time. July had been higher 11 years in a row, like 13 to 14. Listen, we almost were higher. Remember that Friday afternoon? We were higher right at the end. I guess a week ago today. Yeah, but nonetheless, whatever. And total return, S&P was higher in July. But listen, we're using price. It's just you got to have a cutoff somewhere. So you see it on your screen. Okay, so there's something there. Again, I would argue after 16% rally to 2 calendar months before, to give up 1% and 1% 2 months in a row. Honestly, you look at the S&P for 9 weeks, like on candlestick charts and stuff, it went nowhere. It just went sideways. We can correct through time. We can correct through price. Well, I think we corrected through time, and then obviously the assault higher. But just something to think about for everybody. Again, just be aware these 2 months are historically some of the weaker months. I think we had a lot of that kind of, in my opinion, with the war going on and all the different things going on, kind of pulled forward, if you will, a lot of that volatility. I mean, what we had last month with Leopold going under and a lot of
Yeah.
that stuff going on. I think a lot of this was pulled forward. Doesn't mean we're just going to rip higher here. I mean, I know there's an election coming up, and yeah, we all potentially could see some trouble. But listen, there's a lot of other stuff I'm looking at to say we're in a pretty good bullish phase here. And we kind of maybe had our typical midterm year volatility a tad early this year, which is perfectly fine. It happens. I'd say the chart of the year, and we're getting into the F word a little bit with everybody here, but fundamentals. These hyperscalers, you've seen these variations. This is one we made with Bloomberg. But looking at the five large hyperscalers, it's in there. Anyway, some of the largest hyperscalers, their cash flow, right? The cash flow is the part that's going down. I guess that's orange. I think that's orange. Out of these big hyperscalers, so your Metas and your Microsofts and that world. But look at the blue, right? Something Sonu said for a while. One company's spending is another company's revenue and profit margins. These hyperscalers are spending a lot. Well, okay, what's it mean? Well, it goes to the other side, and that's where those semiconductors and a lot of the AI chip memory names have benefited. So I'd argue you could say this is maybe the chart of the year, at least in terms of the story that's been happening. But again, and we don't need to get too into earnings and stuff, because I know everybody saw it last week, but the companies that are still spending a lot, the big hyperscalers like Google, Alphabet, if you had something remotely positive to say on the other side, all this spending is going to maybe pay off. They were they benefited very, very much. And then, of course, the Meta obviously didn't really have much of a plan. The market kind of punished them. So we'll see. But again, I think this is just an interesting one. And these are some other cool charts. Sonu puts these together. Just what companies said they're going to spend. So let's put it this way. We're looking at $1 trillion, right? I guess that's what we titled our podcast this week, $1 trillion, Dr. Evil. There's $1 trillion of spending in the five large hyperscalers you can see on the right. They're expected in 2027. That is 2.8% of our economy, all right? So you're talking almost 3% of the economy is coming from like a couple companies that are just spending on AI CapEx. I mean, listen, that's a reason I think the economy is going to continue to be strong. And I get it. Well, when does the bubble, I hate to say bubble burst. I don't want to say that, but like, when does this stop? When does this slow down? Eventually it will. I understand that. But we don't think we're there yet, and it's just incredible. At the start of the year, those big companies supposed to spend maybe $700 billion in 27. Now it's $1 trillion. I mean, honestly, we'll do this in another, I'll probably update these charts in 3 months, and they'll all be higher. So these are just some big picture things we're thinking about. When we titled our outlook start of the year, riding the wave, and then our mid-year outlook came out a couple month ago or so, still riding the wave. This was one of the waves we're talking about, all this spending and stuff. Maybe these names got ahead of themselves, when you have which is fascinating, by the way. June 22nd when South Korea peaked. June 22nd when semiconductors peaked. That was actually a full moon. No, it wasn't a full moon. It was summer solstice. It was summer solstice. Sorry. My buddy Chris Kimball, hopefully people know Chris. He's done this for a long time. He's seen a lot of times around these solstices, for whatever reason, listen, above my pay grade, but you sometimes see major peaks or major lows. That's very interesting. When South Korea is up 114% for the year, it literally peaked on the longest day of the year. I don't know if that's a coincidence. I've done this for a while. I've seen some of this stuff. No, I don't invest in stars and that type of stuff, but just be aware of. But just up 114%, it was due, right? And we know all those other names in the U.S. up 2, 3, 4, Sanders up 600 or 700, close enough for government work. They were ready for a pullback, and then what happened? Well, then you saw what financials have done. You see healthcare. Listen, I've managed money with Carson Group for 4 years. Healthcare is not a group I really ever talked about. We're like, we have an overweight to healthcare. We've got some biotech, we've got some pharma in there. We're still bullish, yes, but we're looking at the models we have, the money we run, and we're kind of shifting into some other areas that if as this cycle ages, think healthcare might do a little bit better, but there's some things that are happening under the surface that are really positive. But still, big picture, these companies are spending a ton of money, and this is cool stuff. I mean, I was literally on CNBC a little bit ago. Actually, several hours ago. I was on with Morgan Brennan real early. We actually talked about this concept. She brought it up. But these companies all made a lot of money and earnings, yes, huge chunks of it, and I don't know the exact numbers, you can look at the screen as I'm talking, huge chunks of it came because they owned things like Anthropic and SpaceX, and it's like they all own each other, so it is circular, yeah, but that's one reason that, I guess I'm going to call it Google, call me old school. Google had such historic earnings of over $9 a share, expect to earn 2 or 3 because they made a lot of money in their investments that were out there. So just something to think about. Again, the truth about earnings. I've said all year with you guys that we think the Fed's going to run it hot, meaning we don't see any cuts. I guess there's 2 areas I'd say our mid-year outlook was a little bit different than everybody else. We don't think the Fed's going to cut. A lot of people jumped on that train, but we don't think so. We think the labor market's going to improve. Now, listen, I haven't even seen what today's labor market was, so maybe I'm eating crow right now, but we think the labor market will improve the second half of this year. But then you look at it, so the Fed's going to let it run hot. Well, we've been saying, I don't know, the first paragraph of our outlook, start of the year, this is an inflationary growth environment. People hear inflation of 3.5% and just think, oh my goodness, the world has to end. No, that's not the case at all. And you look at what's going on here, we've been seeing inflationary growth. Nominal GDP is running the 6 or 7%. Consumption's running the annualized like 8% the last 2 quarters. Yes, so when you factor in real and inflation, it eats away at that, absolutely. But there's still a lot of things that are happening, that are still positive. And again, just look at what companies are saying. I fly all the time, right? I've never seen a seat on a plane. Literally, like there's no seats on planes. I was in Boston this week for a big event with Carson, my buddy Sanu, I was mentioning, his family was in. He tried to get a hotel room we were at the Intercontinental. Well, I wasn't paying for it, but they paid for it. You're talking $600 a night on a Tuesday, Wednesday night at the Intercontinental, very nice hotel in Boston. No rooms available. I asked for a late checkout. Nope, sorry, we're totally booked. This is like a Tuesday or Wednesday. Then I tried to go to lunch in I forget the name of the place, downtown Boston.
Lobster roll.
Yeah, some lobster rolls, all that stuff. I by the way, I had 3 lobsters. I was there 3 days. I had 3 lobster rolls. You got to do a lobster roll a day. I gained like 4 pounds. I've been losing weight, but I gained a bunch of weight in Boston, so I'm back to the grind. But it was wonderful. What I'm getting at, like every restaurant was packed for lunch. I went to the North End. That's what I'm talking about. I went to the North End early by myself before a flight, like at 5 o'clock. This is all anecdotal. I know, I get it. But there was no restaurant open on the North End, or not open. They were all open, trust me, that I could find a solo seat to sit at a bar. It's like, is it as bad as they keep telling us? I'd say no. We all know consumer confidence is low, but then you look at the other side of the numbers, like, maybe it's not so bad. And I get the K-shaped economy. We understand all those things, but we look at the aggregate, and it's like things are still pretty good out there when we look at things like that. Now, this is cool data. Sono updates this every month. Inflation is broadening out. There's 178 components to core PCE. When you look at that, and I forget the numbers, go my memory here, but like recently we had like 53% of those 178 above 3% year over year. That was like 43% back around April 25th. Yes, we use that because that's when the tariff stuff all started. But inflation's broadening out. More groups out of the 178 are showing higher inflation. That's not the end of the world, but again, it said to us that bonds probably won't do as well. We've been underweight bonds for years, and it's really worked. And if you think about a 60-40 portfolio, how we look at the world, that 40% used to be bonds. Well, listen, we're probably 68, if you look at like our just unconstrained tactical model, we're probably 68% equities, 32% other stuff. Out of the other stuff, we have things like managed futures. We have gold, which, hey, is coming back finally. Got beat up, but gold's coming back. Commodities in general. Dr. Copper, don't have the chart, but Dr. Copper has a PhD in the economy. It's hitting new highs like yesterday, maybe the second we're doing this. So there's a lot of stuff, but this inflation that's out there, not due to the world, just from a portfolio point of view, probably means you just want to own a little bit less bonds. That's kind of a simplistic way to put it. And that's really been working. So here, okay, I've kind of hinted at this and talked about this. Yields are going higher, right? The Fed is letting it run hot. We do have a lot of debt. We are spending a ton of money. The joke I made, President Trump and I think it was Elizabeth Warren. Pretty sure Elizabeth Warren. It was either AOC or Elizabeth Warren, but nonetheless, they don't agree on much, right? Last week, they both said we need to increase the debt ceiling, right? They need to spend more money. They necessarily need to spend more money. That's one place both sides of the aisle agree on, apparently, is on spending money. And people say all the time, and I get to present and talk to clients, we're going to pay the piper. All this debt, we're going to pay the piper. We're paying it with higher yields. If you own a lot of bonds and haven't owned stocks the last couple of years, you're paying for it there because they haven't done as well. Maybe the stock market pays eventually, but I don't think it's happening yet. I think where you're paying the piper is with these higher yields across the board. And we wouldn't be shocked if those yields kind of continue to go a little bit higher. Not massively higher, but that's just the world we live live in. And here, just to show I'm not making stuff up, this is our mid-year outlook. We talked about why the Fed wouldn't hike interest rates this year. Wasn't very popular. Not many people saw that or expected that, but we're still in that camp. Don't need to say anything else on that one. Probably a couple more. GDP, the number came in at 1.5% last week. Not all that great. It's supposed to be like 2.1. Peel back the onion. You look at things like business spending and consumption and residential investment, things like that. That's called like real final demand. It was 3.1%. All right. Sometimes what happens with imports and exports and currencies, all that stuff, that plays numbers and plays games, if you will, with the GDP number. But when you look at real final demand, again, consumption and investment stuff that really moves the needle in your economy, pretty solid. And I think that's what the stock market's sniffing out when it's hitting new highs here. This one might surprise you. I love surprising people. I don't have a lot of technical charts. I always do more fundamentals this week. Hopefully you guys are okay with this. I'm mixing it up. The savings rate. I hear all the time the savings rate's lower. People are tapping into their savings rate. It's like Lee Corso. It's almost college football season, right? I guess an NFL game last night, right? The first preseason game here in Ohio. I didn't even watch it. My boys did. Anyway, the savings rate's going lower. But here's the thing about that. When the saving rate's going lower, usually things are okay because people are worth more, so they don't need to save as much. And I know that sounds contrary to what the media keep telling you, but just kind of glance at this. In recessions, when the economy slows down, when the savings rate soars. So our take for a couple of years now has been, if the savings rate starts to go higher, that might be not corporate America, that might be households saying, okay, now we got to save. And I don't even know how this is exactly calculated above my pay grade, but you see the numbers. There's like trillions of dollars in checking account, trillions of dollars in savings account. I mean, maybe people aren't saving more with kind of the money that comes in straight to savings, but there's a lot of money, still cash on the sidelines, cliche to say, but there really is a lot of cash on the sidelines. But to us, when that turns higher, I'll come on and say, hey, maybe we got a problem now. So we're not there. Just a couple more. Potential worry, it is what it is. Wages are growing about the same as inflation. All right. So inflation is eating in the wages. Of course, you want wages running higher than inflation. I mean, things aren't perfect out there. The housing market, how's that doing? Yeah, it's struggling with what's going on with 30-year. By the way, the last 5 Fed meetings, the Fed has done nothing. They've been on pause, right? The 30-year mortgage, 5 Fed, this is back in February, was like 5.9%. Now it's close to 6.7, something like that. So the Fed hadn't done anything, but longer term yields are going higher. We all know that. I just think it's interesting when you look at it. But anyway, this is a worry. Like, to us, inflation's not a huge worry. I mean, listen, I'm not minimizing the Middle East. That's not a huge worry for us because we're still seeing positives here at home. But our bigger worry is this right here, that if inflation stays high and incomes keep coming down, and this is another reason we think the Fed doesn't need to cut. Incomes, the Fed would be cutting if incomes were really, really going high. They're kind of coming back a little bit. So listen, it's a Rubik's Cube. It's complicated. I'm aware, but this is one thing that has us a little worried. Fear. Listen, there's not as much fear now, but just literally 2 weeks ago after that Fed day, the heat I took on social media for being a bull, the bears all jump out of nowhere and start pounding on you. I'm like, look at these Fed days. Don't ever trust a Fed day. I said that. I said, don't ever trust a Fed day. Then the next 4 days, S&P gained 6%. Tech had one of his greatest 4-day rallies ever. But we did see the 3rd week in a row with more bears and bulls on that AAI sentiment poll. I get it. It's probably the angry people on their bench that are mad about stuff. But I just don't see wild optimism. I don't see wild excitement. I just have to hang out with our advisors this week in Boston. No. Advisors feel good, but clients don't feel that great still. I see them at top of the hour. I think it's the last one. Sorry, guys. I went long.
Don't worry, Ryan.
Yeah, we're at the it's almost time. It's almost time. And again, no, we don't invest just on seasonals, but I like to be aware of this stuff. The best 3 quarters out of a 4-year presidential cycle are coming up right now. Now, I could have easily said the second quarter midterm year is horrific, and we just gained 15%. I get it. That's my buddy Sam Stovall. This stuff isn't gospel, right? It's not gospel, but just be aware. Once maybe we have a little volatility, a little indigestion, okay, that's fine. Once you get to the fourth quarter midterm and early in a 3rd year of a presidential cycle, it is what it is. That tends to be a pretty positive sign, as I'm showing right there. And that is officially the last chart that I had. I went exactly to the top of the hour. I can stay as long as you want. But
25 minutes. Get yourself a drink. That might be a new record here on PMP. That was impressive here, Ryan. But I have just one question for you, because the chat is asking, and I've been asking this question for a long time. What derails the bull market? Like, what is it? Like, we have oil prices that skyrocket back in April. That didn't do it. We have the AI bubble burst last month. That didn't do it. What's going to derail the bull market? Because I've given up and I've just joined the train. I've joined the train a long time ago. I want to be bearish. I love a bear market. I make more money in bear markets. So I love shorting stocks. I'm scared to short stocks. because you try a short spot, it goes up every day. So, I mean, what is the bears' thesis? What's the catalyst that could derail it all?
Yeah, a couple of them that I'll mention here. I think if the Fed became extremely hawkish, we saw what happened in 22, right? The Fed was behind the curve. They became hawkish. They had to hike a whole bunch. Market didn't like it, down 25%, and bonds had their worst year since George Washington was president. That's not our case. We don't think that's the case. I've already said that we think the Fed's going to be a little more dovish going forward. So that's one that could do it. For sure. I mean, you mentioned crude oil. I mean, crude oil literally doubled overnight, whatever the date was, whenever the war started. I think I've mentioned it to you before, and other guests might have. That was like a Six Sigma event. It's supposed to happen once every 4.1 like million years, and it happened this year. Like it happened this year. Congratulations. We have a lot of these Six Sigma events, and I'm with you. I mean, interesting. Who doesn't like looking at the history books? I saw that U.S. the 1990 war. We went into Iraq like 1990 today, like August 7th, 1990. That's when all that started. What happened when that all went place? If you read your history books, oil soared. What happened next? We went into a recession. So in 1990, when oil soared, it caused, that was a minor recession as things go, but we had a bear market and a recession in 1990. We had oil even up way more this year. And what happened? I mean, yeah, the market was volatile, 9.1%, but we sure came back in a hurry. And I saw another thing that if you look at like how much oil we're importing from Saudi Arabia, it's like zero now. Like we don't import any oil. Maybe it's like how much we import versus how much we export. But listen, all I know is we don't import a lot of oil from around the world anymore. And why did we not get as impacted by that? Because of that, right? I know the other side of this. We don't have nearly as much in our reserves. We used our reserves before. I understand all this. But, it is unique that in 1990, oil soared right now, starting today. And it caused a recession. And like you said, Dennis, we had that. And it hasn't. So I think at the end of the day, the Fed becomes more hawkish is the one thing that gets us that could upset this apple cart. But with advanced decline lines hitting new highs and credit spreads, those are the two things I follow. I'm not that smart. Those are two things I follow. If credit spreads aren't blowing out, the credit markets, I think, are the smartest people in the room. They don't sense a monster under the bed. Oh, one more, the U.S. dollar. If the U.S. dollar soared, yeah, that'd worry me. U.S. dollar's up around 100. If you look at kind of the CTFC and what do people expect, a lot of dollar bulls. Everybody's thinking alike. Somebody's thinking General Patton. Dollar probably goes lower here. But if the dollar breaks out above 100 and really starts moving higher, that's one that could upset us too. And last thing, I know we went long, sorry, on Wednesday. 2 Wednesdays ago when the Fed did its thing and the market, I mean, S&P dropped 2% that day. People, it's like, oh, really? Yes. And everybody was freaking out because, oh, my goodness, he doesn't know what he's doing. Maybe he does, maybe he doesn't. But then we had that rally back. The dollar was lower after the Fed day and into that. And my take has always been, if the dollar's going to give us a clue, if the Fed really lost control, I think dollar's going up. I think dollar's going way up if the Fed lost control. So the market and everyone on TV and everybody saying one thing, but if you listen to what was happening, you're like old school John Murphy, shout out John Murphy, RIP, died earlier this year. The message of the market was calm because the dollar went lower after that Fed meeting, and then the dollar's kind of been weak. So you want a lower dollar-ish. A massive spike in the dollar could upset things. But fortunately, I don't think that's the case because too many people expect a higher dollar, and the market has a funny way of not giving everybody what they want. So I think the dollar goes lower. But those are the things that could upset this whole thing. But I don't think we're there yet. I think we got some more good times coming.
Okay, Ryan. Okay. I got it. The fundamentals support this market going higher. The technicals for most stocks support this market going higher.
Yeah.
Right? Could the midterms disrupt this bull market? And what election outcome or policy shift would Wall Street dislike the most?
Yeah. Boy, you'll get me in trouble talking politics here. No, but there is a chance of that. And I'll talk a little bit about midterms. So, the midterm elections in November, right? So that's why you usually get volatility ahead of it. And then the market, that's why I shared the chart, the fourth quarter. Like once you get through that election, things are pretty good. Markets don't like a big wave, blue wave, red wave, whatever we want to call it. Right now, the Republicans have, a 3 or 4 seat majority in the House, smallest in 150 years. And the Republicans have, 53-47 in the Senate. Please don't shoot the messenger here, just looking at the odds and things. We've looked this up, by the way. The last 23 elections, the party that lost the presidency, so the motivated party, in this case, Democrats, they gained seats 20 out of 23 of the 20 of the past 23 midterms, okay, in the House, an average of 29 seats. So not saying anything that's hopefully too controversial. Democrats probably take back the House. Republicans probably keep the Senate. They have a little bit easier map on the Senate side. That's called a split Congress. The last 13 15 years, we've had a split Congress. Take a wild guess what the SP 500 did. It went up. No, and I know there's some randomness to it, but maybe not. What the market doesn't like is a huge wave, and that's more spending just for whatever your policies are, but it means the other side's not going to do what they want, or maybe you spend too much. We all know we spend a lot of money in Washington. Maybe you spend too much. That could be that could really upset things. But if we wake up, I don't know what the date is, November 5th, 6th, 7th, whenever that election is, and there's a split Congress, that could be the best scenario for investors out there. So that's something that we're paying attention to. One more comment on this. I know this is more for traders. Like when I talked to like grandma heard on TV, well, if so-and-so wins, it's good for oil stocks, or if so-and-so wins, it's good for bank stocks. That stuff hasn't happened at all. Like literally when Trump wins in 2016, he hates Jeff Bezos. He's going to big cap tech. Tech does incredible. Joe Biden wins in Joe Biden wins. Oh, coal's going to do horrible. He's going to get rid of it. Coal's like the strongest thing. It's never that simple when it comes to kind of what
Good
they tell you on TV to what really happens. So just something to be aware of. But I think a big wave in November, to specifically answer your question, is what would potentially upset the market a little bit.
Ryan Dietrich, Chief Market Strategist at the Carson Group. Even when I ask him for something bearish, he comes up with something bullish. I love it, Ryan. We love your
right.
We love your contributions to the Stock Trader Network. We're going to get you back in next month. You know where to find them for extended coverage, technical, funnel, analytical, sentimental, all with Ryan Dietrich. Thank you, Ryan.
Thanks, guys. See you next time. Appreciate everybody out there. See ya.
Premarket Prep, weekdays, 8 to 9 a.m. Eastern Time.